Hey guys, Toby Mathis here, and today we're going to talk about the big social movement that's been going on with GameStop, with BlackBerry, Bed Bath and Beyond, AMC, and what you're seeing going on. And I'm going to break it down like this. Wall Street for years has been doing something called shorting stocks. There's nothing inherently wrong about it. It's basically just saying, hey, I'm going to borrow somebody's shares. I'm going to sell them, take the money now, and then I'm going to have to buy those shares back at some point in the future. Sometimes it's a short period, sometimes they get a little bit longer, but I'm going to have to buy those shares back. So I always equate it to borrowing my neighbor's lawnmower and immediately selling it, knowing that, I borrowed it for a week. So I have a week to give them back the same lawnmower or the same brand. Maybe I have to give them a brand new one, but I'm going to have to go buy that lawnmower. And so I let's say that I borrow the lawnmower, I sell it for $100, and I think that I could buy that lawnmower from somebody else for $50. That lawnmowers are going to go down in value, and I'll be able to buy it for cheaper, and I'll keep the spread. So if I did that, I could buy a lawnmower for $50. Let's make it real. Let's say you borrowed it for 6 months or something, and you borrowed it before lawnmowers went on sale. So you knew that you could sell that neighbor's lawnmower for a premium, and you're going to buy it back when it goes on sale in the spring or something like that. But instead of going on sale in the spring, there's a complete run on lawnmowers and they double in value. So they go from 100 to 200. I still have to buy the lawnmower and I'm going to have to pay a lot more. That, in a nutshell, is what's going on with GameStop, with AMC, and all these others. Is there's a lot of shorting activity where people thought that those companies were going to go down, and inherently, a lot of these folks that, like, if they're a big hedge fund and they're basically vocalizing that something's going down, you can't actively go and influence the shares. But let's be real, these folks do talk about the market. They do create some negativity with the idea that perhaps it's going to help their position. We saw that during COVID. We saw people get on and make dire predictions at the same time that they had shorted or were hedging on the negative downside. And I don't know whether they violated any laws when they do it. I imagine that they probably are in the gray area or just outright violating it. But it doesn't mean that they don't have friends or other people that may go do that same dirty work, but they're pushing the company down. They're saying, basically, I think the company is going down. There might be enlisting some help to encourage it to go down, or maybe they're just withholding their opinion. Hey, tell me about this company. Oh, I'm not going to talk about that. I just gave them the tacit idea that I'm shorting it, right? So a lot of people on Reddit got together and said, hey, these companies are important to us. They remind us of our childhood. And they went and they said, hey, we can do battle with these what they perceive as evil forces, trying to knock off some of their favorite companies. And so they buy and they won't sell. There's people that do profit from it and they sell as it goes up, but there's a whole bunch of them, and they say hold, but they spell it HODL. And they're like, they always say, hey, we're just going to buy it. We're just going to hold, and, hold the line, hold the line. They're always doing these rallying cries of don't dump your shares, because if I'm not selling, that means that there's less available to purchase, which is going to drive the price up. Supply and demand. There's more people buying it. So they go out there and they're all like, hey, just buy and don't sell, buy and don't sell. Eventually, somebody's going to have to cover their short position. So remember, they borrowed the lawnmower, they already sold it. So they borrowed AMC shares and they have to cover, and they're going to have to buy it or whatever the market is. And the idea with these groups of investors is to drive the price up as high as possible. So when they do have to go in and buy it, that they're going to be paying a premium to do so. Now, that in and of itself is simply fighting fire with fire. If you don't like the fact that somebody's shorting, make it painful for them to short. So maybe they stop doing it. The problem that you have is that so many people are shorting, and there's something like, you're going to hear the term naked shorts and stuff like that, where there's so many shares being shorted, it's actually more shares that are in existence. So they didn't borrow, like they're borrowing the neighbor's lawnmower without even borrowing the neighbor's lawnmower. You end up borrowing the same lawnmower 3 or 4 times. 3 or 4 people are selling the same lawnmower, and they have to cover, but there was only one lawnmower in the first place, so it's like they're going overboard, and maybe that's not legal as well. Maybe there's some people skirting the rules, and the SEC's never really paid attention, but I assure you they're paying attention now. And these retail investors, as they call it, the people that get together, that it's not a hedge fund, it's just a bunch of people on Reddit, it's people on social media, they're using Twitter, et cetera, to communicate. And they're basically saying, hey, we're buy up this and don't sell it. Buy it and don't sell. Drive up the price. Make these people pay for the fact that they were betting against our favorite companies. And there's nothing inherently wrong with that. That actually makes sense. I imagine that there might be a rule here or there about market manipulation or collusion that the SEC might jump up and say, hey, but it's not what you're anticipating. They're not trying to even make necessarily a profit out of it. They're just trying to punish the people for hurting the brands that they really care about and love. And so they're saying, hey, basically, if these folks are going to do that, we're going to hit them. And what they're saying is don't sell it. Let it transform. Give the company the opportunity to fix itself so that it can stick around. And again, that's BlackBerry, Bed Bath & Beyond, AMC, and GameStop are the big ones. There's a bunch of others I'm probably missing. These folks band together. They call themselves apes. They're going out there. So I fully encourage it. They're basically saying, hey, we're done letting like I've been saying this for years. Wall Street really takes advantage of the retail folks. A lot of times they're selling us stuff, and when you see the market correct, you see who's last to get exited out of a position, who's taking it in the shorts worse, and it's the little guy. And so a lot of the little guys got together and said, hey, we can play this game too. And Wall Street probably doesn't like it much. Now, from an investing standpoint, I'm going to reiterate our philosophy, my philosophy, which is you buy things that pay you. So you're buying companies that pay out healthy dividends, that are profitable and are successful over a long period of time. It's rare that you're going to be buying stocks as an investment that have not been profitable for at least 10 years, paying out increasing dividends for at least 10 years. And frankly, we'd prefer it if you stuck to the 25-year line, which means you're not going to be investing in a lot of these companies that you're going to hear about that are being shorted, because they're not going to be shorted because they've been paying out an increasing dividend. You buy things that pay you, and then you compound that by selling options against it. I call it being a stock market landlord, where you create rents off of your holdings. So all of this, the GameStop, the AMC, BlackBerry, Bed Bath & Beyond, all of these things violate those principles. So we wouldn't invest in them. But I'm not going to tell you don't be part of a social movement. I'm going to say if you're willing to do that, just know that your money may not come back to you. But it certainly has a place. It's not going to be, in an investment portfolio. We're not going to call that an investment. We're going to call that other activities. Basically, it's kind of your gambling money. You're just doing it to tick them off. And it's kind of like if you're in a poker game and you see somebody bullying other folks, you might push in trying to smoke them. If you know gambling, you know what I'm talking about, because you can gang up on somebody if they're being a bit of a bully on the table, and the other gamblers start to unify against somebody. In my town in Vegas, I'll tell you that there's professional gamblers, and they go 2 to 3 into a table, and you won't know that they know each other. And that's exactly what they're doing, is they're just trying to take the money from one. And that's what these retail investors are essentially doing, is they're getting together saying, hey, we're going to focus on this hedge fund that shorted my favorite company. We're going to make them pay up the nose to buy it and cover their position. So, who ends up paying that? The investor in the hedge fund ends up paying that. And if they don't sell and they hold their shares, what's going to happen is you're going to see these companies start to recover, because there's people not dumping. And if they're buying everything up, that's going to force the shares up. It's just law of supply and demand. It's not fundamental. There's nothing behind these companies where you say, hey, there's a strong reason as to why they're doing it. It's purely emotion, it's purely relationship. And again, it's not what I would call investing, but it does have a place.